There has been one question that seems to be asked all the time, and it comes from people who are new to the space. And I want to help you guys understand this. I want you guys to understand where this answer, this question comes from. And the question is, if Koinos is feeless, if it's free to perform transactions, how do block producers, how do dApps make money? And the assumption is that because there are fees on Ethereum, Solana, those fees go towards the applications that are running on the blockchain, and this could not be any less true. So if you're on Solana, if you're on Ethereum, you're paying transaction fees. If you're on Ethereum, you're paying a lot of transaction fees. If you're Solana, you're paying less transaction fees, but your blockchain might stop. Anyway, if you're paying these transaction fees, where are they going to? So let's dig into it. Let's say that here we have a transaction, right? This is a transaction, and this transaction says, well, we want to do some stuff here. We want to interact, mint NFT. Let's mint NFT, pay gas fee. Those are the two actions that we have in this transaction. Now, when you do this, two things are happening. You're doing an NFT mint. Here's your mint NFT, and that's going to cost you, let's say that it costs you 10 ETH. We're back in 2018, guys, where 10 ETH isn't a lot of money. And here's another, and it's the pay gas, and the gas fee is 1 ETH, which is not unusual. I mean, this actually is pretty unusual, but it does happen. All right. I'll make this a little bit more worth it. 0.1 ETH. Okay. So you have a mint NFT and you have a pay gas. Now let's break it up even further, right? There's this guy here. This guy is your good old friend, the miner. He is a proof of stake miner. This proof of stake miner has been in this particular slot, and it's this person's job to take this dark omnisphere, take this transaction and add it to the blockchain. He's going to confirm it. And so the gas fee is going to the POS miner. Then under EIP 1559, it's likely that this gas fee is going to get burned. There might also be a tip. And that actually is its own transaction that I forgot to add here. Tip. Let's say that tip is 0.1 ETH. You don't have to add a tip, but if you don't add a tip in today's time, you probably won't get your transaction mined. The tip goes to the miner. This mint 10 ETH, that's the fee that goes to the project. And so your fee structure is really separated into a lot of different pieces. And I think that's where people tend to get confused. So let's go back to the beginning here. You have a transaction, and in this transaction, you're minting an NFT, you're paying gas fee, and you're including a mining tip. The pay gas goes to the POS miner, which gets burned under EIP 1559. If you're running that on Ethereum, obviously 1559 is an active proposal, and therefore majority of the gas fee actually gets burned, which makes the blockchain deflationary. The tip goes straight to the POS miner that produces that block, and then the mint fee will go to the project. And so people wonder, and they think that, oh, all of these fees must go to the project's making money, and therefore if you don't have a fee, the project doesn't make any money. But clearly this is not how it works. And I think the problem is that people don't see this broken down this way. This is the Ethereum style that we have here. And what we want to establish is what does a Koinos style look like? Let's look at the Koinos style zero fee system. All right, so we have this transaction here. Same thing, same similar setup. You're a user on the Koinos blockchain and you're trying to perform a transaction. You're minting an NFT set and it costs you some mana. So let's take a look at your wallet. Your wallet's going to have, here's your bigger wallet right here, the boundary for your wallet. And in your wallet here, let's say that you have some tokens. You've got, 100 coin, which equals 100 mana. That's it, simple. There's your wallet right here. my wallet. So if you have your wallet here, you've got 100 coin, you've got 100 mana, and here externally, we're going to have the miner. And the miner's running a full node, right? Which has all the microservices that know how to deal with mana. And so there's your miner right there. And then you also have the project developer, the project that you're interacting with, the NFT project. So NFT project smart contract. So here are all the players involved here. Now, the mana cost for this one, let's just say that the mana cost equal to 0.5 mana. That's how much it costs to run this transaction. What's happening here is that when you perform the transaction, your mana isn't going to a miner because mana is not a token. It is not a property. It's not a tangible thing. It's just a property. And so if this transaction costs 0.5 mana, what's happening now is that in the new state, after the transaction is complete, you have still 100 coin, but you've got 99.5 mana in this particular case. Remember, you still have 100 coin. And even if this costs 5 mana, you would only have a difference of 95 mana. You would still have your 100 coin. That is the big difference here. No tokens from your wallet are ever transferred. What's happening now is that 5 of your coin is no longer transferable for a period of time. It's held there in your wallet. You can't move it. It recharges over a certain period of time, depending on how much coin you have. If you want to check out the video on how long it takes for your mana to recharge, you can look at that one to get a sense of how long it takes to recharge. But in this particular setup, it may only take a couple hours. So you've locked up 5 coin in your wallet, never transferred it out. You now have less mana. The miner mines this transaction. And the big question is, what about the fee that gets transferred to the project? Well, if the mint NFT is free, right? If the mint equals to free, then no tokens ever get transferred to the NFT project. But in this particular case, the contract can define the cost for minting. It can say that mint is not free, mint is 10 coin. Well, in that case, you would take 10 your coin, where's the laser beam here? I believe that button is called K. Your 100 coin, you're gonna reduce this value by the cost of whatever this is, and then it's going to transfer to the project. So it's up to the project to define how much coin is going to cost for this particular mint. And they can charge whatever they want. They can charge 0. And in that case, you're never going to lose coin to run this project. And that's the magic behind Koinos. Because if it wasn't an NFT project, maybe it's something like Koinos Social, where you're trying to post a comment onto the blockchain. It's going to consume mana, but it's going to cost you 0 coin. And you can do that for as long as you like, because you have enough mana to consume or to post however many posts onto the blockchain. And so it's project specific. And what this does is that the Koinos blockchain enables project developers to define how their project is providing value to their customers. And the blockchain is not taking a cut of that. It is not doing that. And therefore, projects get the maximum ability to give value to their users. They can cover the mana costs and they can give you value all without taking any of your coin, and they can make money other ways. So very, very project dependent. Now, another question that comes up is, how do miners make money? How do miners make money if there is no gas fee, of course, being burned on Ethereum, or a tip like there is on Ethereum? Well, miners get paid through inflation. And so each time they produce a block, they're going to earn a little bit of a reward from the blockchain. And so Koinos is an inflationary blockchain. The current inflation is set at 2% of the total supply. They get a slice of that each time they produce a block, and therefore is an inflationary blockchain. The big thing here, and it goes into a different topic, is whether inflation is good or bad. Inflation has helped the world become what it is today, but the negative part about that is that the inflation is being manipulated and controlled by banks. They're being controlled by agencies. You have no way to control inflation of the money supply, inflation of the monetary supply, that is. In fiat currencies, they are able to print these things at will. You have no say in it. And obviously in blockchain, you know exactly how much is being printed. And coin holders, if you look at the other video about voting, they can vote to change the inflation rate from 2% to 5% or whatever number that works for them. They can also bring it down and up, but obviously that requires a very present and visible vote. You will know and see when that happens, unlike monetary systems, the fiat monetary system, where central banks are allowed to print as much. So that's the big difference in whether inflation impacts you or not. So miners get rewarded in inflation. They get nothing from processing transactions, and therefore miners' incentives are generally, pretty well kept. Right now, the inflation is 2%, but what this represents is an APY for miners that roughly equals 4 to 6% is what we're seeing right now. And that's very much in line with Ethereum. Most people who are running POS miner, they get about 3%. It's a very, very common number, and it's safe. It's guaranteed. You're not going to lose any money because mostly in this particular case, with POS miners, you're going to be depositing your Ethereum tokens into a pool, because unless you have 32 ETH, that is. But on Koinos, there is no requirement to run your own node, and therefore you have these assets in your possession at all times. It's guaranteed. The system produces it for you. You have pretty much no risk except for the risk of holding a token for a new project. Anyway, I hope that helps you people understand exactly why miners don't get paid through gas fees on other blockchains, and why the zero fee system actually maximizes the ability for projects to be able to create applications that provide value, because they no longer require this whole transaction of gas fees. It doesn't exist in the system, and the cost of mana can be paid for by anyone, and it doesn't actually cost anybody anything. No tokens are being transferred. Anyway, I'll finish it right there. Take care. Have a good day.